Venugopal Garre for Bernstein is now joining us live on this edition of The Market. A great time to have him on board. Just seeing the kind of week we had, where we had 18,000 kissing distance, very close to the all-time high. So, Venugopal, my first question to you is: today, of course, you see the market may be under a bit of pressure, but your Nifty year-end target is pretty much where the index is trading at the moment in the month of April. Would you stand by that target of 17,500 to 18,000?
Yeah, firstly, thanks a lot for getting me on the show. So, that's a very good question because normally, giving this argument of flattish returns or index staying flattish, typically tends to be very tough because you always expect some returns on both directions. Now, it's interesting that since July last year, we have been sort of the view that there is very limited returns to be made on the market on the upside, and we're probably going to be sort of in a flattish range bound sort of situation. Now, which we doubled down on that view in January as well in our outlook, where we highlighted very similar target price, for the index as well. And the viewpoint simply was that this is the environment we are in, where there are a lot of potential risks. Initially, it was about higher valuations, and thereafter it was about potential global challenges which are emerging, especially the volatility that we see. But at the same time, our argument is that the risk of a hard landing to us appears low, given where we are, a couple of years of hardly any macro growth, I would probably say, on an absolute sense for GDP. So I think that is what makes this argument of staying flattish, which itself is a very powerful argument. And I'll tell you one more aspect here, because if you look at what is happening globally, I tend to hear a lot of these doomsday scenarios of late, which appear very powerful because, you look at where commodities are, the volatility around there is a war going on. Look at what is happening globally to yields. And inflation containment measures are meant to bring down demand in some way. And I think India cannot escape all that. So the point is that, whenever we have seen such situations in the past, we have seen fairly brutal corrections for the Indian market as well, probably lasting for 6 to 8 months, which we characterize as a bear market. Now, this time around, to a large extent, we have digested a lot of that news flow, which itself is a fairly underlying, interesting sort of a trend.
So if you expect the Nifty's returns to be capped and to be staying in this kind of a range itself, how do we see the change in momentum when it's coming from FIIs? Last financial year, they sold 1.4 lakh crores. So far in April, the buyers of more than 7,000 crores. Are you telling your investors and your things differently? Is the era of creative storytelling behind us? Yes, I'm copying that from a previous report of yours.
Creative storytelling will always remain. I think when macro doesn't support you, you have to create stories to sort of, bring that hope. And the hope, as I mentioned, is always about cycles, about long-term secular potential and things like that. I think that's not going to go away. That's a reality of equity markets in any case, because we tend to basically, invest based on the future rather than what is happening today or in the past. Now, I would perhaps say, the context of where we are at this juncture, the question that, you would probably still want to ask is why remain in equities at all? I think this is a question which a lot of global fund managers, especially on those who have the ability to sort of, take down positions in specific countries, might be thinking and have been thinking about it. To some extent, you would have already seen that in the $14 to $15 billion sort of fairly large FIO outflows that we've seen in the last 6 to 8 months. Now, but the point is, incrementally from here, these challenges from an equity market point of view stand pretty well, hold good across the world. So it's not like India is, specifically in a very different thought process of having some challenges which are more than the others. I think this is what perhaps is something which could somewhere down the line lighten those outflows to an extent, unless something really changes in terms of domestic macro context itself.
Interesting. So, Venu, given, the landscape that you just painted for us, given the fact that you don't believe that equities are going to have a run anywhere close to what the, past 2 years, the recovery that we saw from COVID lows was, there's got to be some hiding space regardless. Which are the spaces that you are still overweight on and you do recommend buying into?
No, that's a good way to look at it, because unfortunately we're all tied to the markets. Bulk of the markets are, primarily centered around funds which are indexed and they need to have positions. So I think the change per se is this, that one has to be, very stock specific in my view. Some bottom up opportunities always remain in every possible market. And that's something holds good for now as well. But it's going to depend from individual, fund to fund. It could be very different thought process about what they like versus the other. But the main template for you, which is very important here, is certainty of earning streams. I think that is very important when you look at stocks at this juncture. And more importantly, how far away are they from potential global macro volatility or risks? So these probably two things are very important. Now, we tried assembling a portfolio. So we've been running this portfolio for 2 years as a paper portfolio, and we have about 13 stocks, 12 longs, 1 short. But the idea that we went through as a team when we thought about these stocks were primarily these two things in mind, the template. But at the same time, I'm of the view that the churn has to be very quick. I think short-term rotation between stocks to stocks will have to be a bit more aggressive in this environment to generate that extra alpha that you would want. Sitting with long-term stories at these junctures is very, very dangerous if you don't really have a near-term catalyst. So this cannot hold good in this phase of the market. The other thing we basically highlight is, take a sectoral context as well if you want to basically, take that view. Now, we, when we build this sectoral context, which haven't really changed that in the last 8-9 months. And the reason being is a view on market hasn't changed. That's basically IT, healthcare being overweights, industrials, financials being overweight, which is more domestic cyclical recovery plays. But within that, we just cut down our industrial exposure a bit at this juncture, but we're still overweight. Outside of that, as you know, we've been sort of cautious in consumption. That remains. Digital stories, we shifted to an underweight in January. Now we're more neutralish. So that's how perhaps, sectoral context is. But just to highlight, this sectoral context is not a recession-proof sectoral view. It is more with the viewpoint that things are okay. You tend to see some challenges, but then eventually you will see a macro recovery sort of shaping up over a 2-year view.
Did you actually use the R word, Venu? Clearly, you've been tracking the bond markets closely.
Yeah.
So you feel a recession is imminent at a global stage, or at a global level?
Sorry, I didn't get the question. In terms of where we're going to head on that side? On the bond market side?
You mentioned recession. So I was just wondering that clearly you're tracking the US yields pretty closely, because the US bond market seems to be suggesting that there is a recession in perhaps in the next 2 years.
Yes, that's right. I mean, the problem is it's been talked about a lot. There is ample proof of, how things shape up in the past when such episodes happen. But my worry beyond these quantitative metrics, which give you some view in the future, is that in general, inflationary risks globally are fairly visible. Now, it's unfortunate, but, you have to create some forced slowdown from a demand point of view, through these interest rates hikes, which are perhaps you believe could be measured, but there could be some rapid rises from time to time if, you're not able to contain inflation. So that's something which, is a challenge, from a global context. And I think India, may not necessarily escape that as well. Even though our global linkages may not perhaps be that large, but there are still linkages, from a point of view of currency and flows and things like that. So, the change, not really a formal, but sort of a change in RBI stance towards, how they're looking at interest rates probably gives you a signaling that it's better to signal a potential that we are going to be taking such measures in future, rather than saying that we're not going to do it. Itself is a good sort of a decision, I would say, that they have done. It sort of still keeps markets in order from that perspective.
Morning, Venugopal. And when it comes to, deconstructing the entire, construction materials or this real estate space as a whole, one can't ignore the high energy and freight costs as well that we've seen, and particularly for some of the smaller developers as well, where raw material prices will be disproportionately higher. So how are you looking at playing this metric in light of these concerns?
No, that's a fair point. My thought process is to still stay away near term, because it's all near term these days. So near term, stay away from potential challenges where you're going to see input cost pressures or, higher prices dampen demand a bit, right? That's a possibility. So what we are in that situation where we are underweight building materials because we think that is a challenge in the near term. But at the same time, industrials is a very, very different sort of a space, because industrial companies typically have the ability to pass on prices through their price variation clauses and things like that. Plus, they're not overtly real estate dependent. They're still dependent on government contracts or private contracts, which there is, less of a challenge from that perspective. So this explains our industrials overweight despite, what is happening, on the challenges and underweight in building materials at this juncture. Now, this does not mean we are negative on real estate long term. I do believe from a cycle perspective, there is still room for real estate, over the next 4-5 years to still do well. Normally, when real estate cycles start, they tend to last longer, and same works on the reverse as well.
Okay, and just wanted to understand as well what the outlook is then, just taking that point forward when it comes to the entire auto as well as auto ancillary sector, which will be, of course, facing some similar challenges that you flagged off.
No, that's true. I think auto, there is a lot of uncertainty. Actually, we were underweight last year. We went to neutralish beginning of the year, and then there's another bout of volatility. So in that context, we're still not very, very constructive on autos overall. That's the way I would put it. Yes, there could be challenges both on supply side emerging from time to time, as well as, the cost side push, which is going to be slowly pushed to consumers, which of course is an impact. And from an auto ancillaries point of view, of course, they would, they are external facing as well. And I think that's something which we need to see how much of exports in general gets impacted if we're going to be seeing some global slowdown. So that's the situation with autos in general. But there's only one thing which keeps me from underweight in general from domestic stories is that if you look at the autos overall volumes where we are at this juncture, we are still at levels which were there 3-4 years back. So there, so that sort of protects the downsides beyond a certain stage. And plus margins in general for some of the companies are at 10-year lows. So that's probably a potential positive, at least at the background, which keeps us neutral.
Venugopal Garre, before we let you go, one final question. I'm borrowing this from your report. So just after everything that you've said, do the Indian markets have superpowers? Is that what explains the resilience?
Oh, yes, it does. I mean, it's amazing that we're having a war. We are seeing supply challenges globally. We are seeing, look at where yields are moving globally. There's inflation, which is there. $14 billion to $15 billion of FII outflows. That's large in the historic context as well. We have digested everything. So I think that's a very powerful statement. Another thing which I would like to leave with his thought is, as I mentioned, odds are always in the favor of bull markets in India. Look at a 25-year history.
Okay, so going by the last 25 years of history, it certainly does look like the bulls are very much in favor. Thanks, Venugopal Garre, for joining us live today.